I like to think about real estate and my plan as my plan of financial freedom. The first things I do in my plan of financial freedom is I first have to maximize what are the good deals I can find. This is going to be my wealth creation. And then number two, even before asset protection, in terms of like what's the number one thing I'm worried about is how much money I have coming in for my tax strategy. Real legal solutions, we also know that asset protection is absolutely essential, and a lot of times it's our foundations. And so one of the things that we can do early on in our process is actually talk about asset protection to be able to set the foundations for the tax strategy. And as you see, when we get into the tax strategies here, and as part of this discussion, that it gets pretty involved pretty quickly. So when we look at tax strategy, where do we start? We have three places we always start. One is to use your children. If you can pay your children's salary or other money, right? You can actually be able to then pay the tax at the child's tax bracket. So that's the first thing that we use to do. And it has to be a reasonable salary for the work performed, but it can be a high to reasonable salary for the work performed. And there's some benchmarks we use for audit protection reasons for what would be a reasonable salary to pay a child to perform that work. Another thing you can use is your house. And the question we ask is, are you maximizing your home office deductions? Are you doing the right things there to be able to get every cent out of the home office deduction you can? And are you writing off your vehicle expenses? A lot of people don't think to write off their vehicles and their vehicle expenses, but you absolutely can, especially if you have two cars, for example, right? The more expensive car, why not make that owned by the business? As long as you have alternative transportation, and one can be vehicle, can be all personal, and the other one could be all business. It doesn't matter what that personal car really is. When we're thinking about like what deductions to take though, I want you to also be thinking about what deductions are going to be inhibit my way to do business. Remember, number one is around wealth creation. So that's going to be our ability to get financing. That's why you have an operating company set up to protect your credit score. That's also why you need your debt to income ratios to look right when you're going for financing, and the types of deductions you take can impact your ability to get financing. So you have to think through those. With a solo 401k, you can save $58,000 a year in taxes. If you're married, that's $116,000 that you're able to pull off of your income and shelter that from taxes. What's great about the solo 401k is that you can take your rental income that's otherwise not qualified to be a solo 401k, you channel it through your operating company. Now it's active income, and now that it's active income, we can push it into the solo 401k. Now once it's inside the solo 401k, we can buy real estate with it, we can buy all kinds of investments with it, and we can make all those decisions ourselves and handle everything ourselves with those investments. The great part about the solo 401k though is that it gives you the opportunity to loan up to 50% of the value of the solo 401k back to yourself. So that way you can, you're going to be able to access cash if you needed to out of your own retirement account, and then you just repay it over 5 years at about a 5% interest rate. We also like to layer in a self-directed IRA that has some contribution limits with what you can add. I think this number has gone up as well too. I think it might be that $7,000, $8,000 range now. But essentially you can add that on top of your solo 401k. So if it's $58,000 with your solo 401k, you can add another, I believe it's $7,000 into your self-directed IRA, which gives you that like $65,000. And then same thing, the self-directed IRA, you're going to be able to manage that everything with yourself. As long as you set up an LLC that's owned by the IRA and invest through the LLC, which is something that we help you set up. That's an additional $7,000 every year, $7,000-ish every year that you can shelter from taxes. There's also what you can use is the defined benefit plan, and on top of the solo 401k, it's known as a DBK. And with these DBKs, they're created here in 2006. They combine the benefits of a solo 401k as well as if you want to use an IRA, you're able to do that. And with when you can add in the pension strategy, there's some calculation about how much you can contribute into that pension at any one time, but that gives you another shelter that's above the solo 401k that all pushes it into a retirement fund, so you can grow your wealth with that deferred tax. So you have more capital in play, which means your gains are going to be higher.